Hello folks, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital. Today's topic is on this irrational risk-taking that we see right now. Right? The question I pose is it actually rational for this excessive amount of risk-taking that we're seeing? And surprisingly, the answer is yes. Yes. We've got so many headwinds right now, you would think that equity should be tanking. But there's a huge but on the other side of this that we're going to talk about. There is a reason that we're seeing this craziness, right? We're seeing record high PE ratios, right? PE ratios like we haven't seen since the dot-com bubble. And we're seeing some other things that I'm going to show you, right? They just seem nuts. But there is a possible reason for that. So let's jump in. Let's just lay the groundwork here. What are we talking about here in terms of all the headwinds right now? Some of the current concerns. Of course, the China trade deal has fallen through. Hell, for the last 2 years, every time a good piece of information about the China trade deal came out, markets went up. Now that it's all but dead, you would think the reverse has to happen. We're not seeing that. Chinese equities are doing well. U.S. equities are doing well. What? That just baffles the mind. What the hell's going on there? What else we got going on? Number 2 here. The coronavirus cases, right? Are we seeing a second wave of the virus? Perhaps, right? The hospital capacities, the hospital beds are again being stretched, particularly in the Sun Belt areas. That should be enough to concern investors, right? The reopening of the economy has been delayed. That should be enough to scare the hell out of investors. That's not happening, not a bit. What else we got here? Number 3, the worst earnings season in 10 years. We're just about to kick that off. The worst earnings season in 10 years. It's almost surely going to happen. Now, one thing I would caution you on this is I wouldn't read too much into this quarter's earnings. Right, because there's going to be some bathroom sink, kitchen sink. That's the word, kitchen sink sort of activity, right? Firms that have bad earnings, they're going to take the old formula from Goldman Sachs, right? If you're going to have bad earnings, make them terrible, right? Take all the write-offs, all the drawdowns, put it all in one quarter and get it behind you. So that very possibly could be what we're seeing. Not only are earnings going to be bad for some companies, they're just going to tank their earnings altogether, most likely. Hell, I would if I was sitting in that CEO chair. This is a good opportunity to take advantage of it and try to clear up some of those lingering issues here. All right, so that's number 3. What else we got? Number 4. Of course, we've had this big increase the past week in announced layoffs. Airlines, we're talking about tens or hundreds of thousands of people. In the airlines, in the energy sector, in the retail sector, we're talking about massive amounts of layoffs that are coming up. I think of those really as the second order effect from the first wave of the coronavirus. The second order effects. I think there's 2 of them. And that is again all these layoffs due to the increased cost of employees to safeguard. Right? The costs are going up while earnings are coming down. So the layoffs, the second order effect, the layoffs from the first version of the virus, I think were inevitable. The second one is right down here at the bottom. The second order effect is the spike in bankruptcy here. Right? And we're already seeing it. Right? We have Brooks Brothers, we have all kinds of retail shops, energy shops. We have personal bankruptcies as well. They're going one way right now. They're going one way, right? That tsunami that people have talked about, that's just starting here. So we got all kinds of shit to worry about right now. And yet equities just keep going up. Not only in the U.S. either. Not only in the U.S. So how can the fat man here come up with any rational reason for it? And again, I think it's nuts. Let's be very clear about this. I think this environment is nuts. We are in a bubble. But what caused the bubble? Here it is, folks. The real rate of interest. Real returns are down here. Negative 60 basis points your 10-year real yield is at negative 60 basis points. And if inflation ticks up a little bit, of course, or if inflation ticks up at all, that's going to push these real earnings down even worse. What the hell does that have to do with anything? Well, if you buy fixed income and you're guaranteed a loss in your real purchasing power, this is real dollars, real investment dollars, right? Who's going to do that? They're first going to try to find areas in which they can get positive real returns. That's the idea of investing. It's not just to get positive nominal returns. Ultimately, you want to end up with more money to spend. So as long as the bond market has these negative real returns, there is going to be a fair bit of interest in all other areas, right? That's what's driving this excessive risk taking. If the catalyst here, or let's say the nucleus, is the negative real rates, what is behind that? What is causing that? And that is the money, the dollars in circulation, the U.S. money supply. Look at this bad boy here, ladies and gentlemen. Dollars floating in the economy are growing by 33%. 33%. Each $100 that was here a year ago, now it's $133 floating in society. Oh my gosh. Oh my gosh. Chairman Powell says that he thinks the risks today are unprecedented. Folks, I'm telling you, that's one man who puts the money where his mouth is. Look at this chart. 33% growth in the money supply. Just compare that. Compare that. Here we are, the 2008 stimulus program. And they call that the Great Recession. Hell, great what? This is great. Well, if that's great, this is marvelous. I don't know how to describe it any other way, right? We are seeing a stimulus package in the U.S. like we've never seen before. We're also seeing it like no one else in the world has. The amount of dollars that we're pumping in is uncomparable to anyone else. And of course, that is what's driving interest rates down. That's what's driving these real rates of return down right now. And that's given rise to this craziness we're seeing, right? The PE ratios that are back at dot-com bubbles. They seem nuts. Well, that's not the only one. Here, I'll give you another one here. This is a spread between Italy and Germany. And of course, Italy was one of the hardest hit countries by the virus, but the spread keeps coming in. Spread keeps coming in. So Italy had a terrible balance sheet going into this, hard hit by the virus, having to issue debt just hand over fist, and yet the market doesn't care. The market doesn't care. The spread just keeps melting. You see, on the one hand, you see them back, and then you say, this is nuts. This just can't continue. And I do agree with that. But it's not as nuts as you think when you have to compare it to the alternatives. The real rates of return being negative and highly negative in many areas of the world, they at least partially justify this excessive risk-taking that we're seeing today. All right, so that's our message for today. I'm Don Rich, and you just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.